Welcome to the latest in AXA's podcast series, Life with inSight, a commuter podcast series where the advanced markets team will be interviewing today's thought leaders on issues that affect the life insurance industry. Today, Randy Zipse, a vice president in the AXA Distributors Advanced Markets team, will speak with Barry Flagg about life insurance as an asset. Barry Flagg is the inventor and founder of Veralytic, the only patented online publisher of life insurance pricing and performance research and product suitability ratings. Veralytic is the product of Barry's unique background as both the youngest certified financial planner in history, schooled in investment business, as well as a life insurance practitioner consistently ranked in the top 1% of the industry. His experience in financial product analysis, life insurance sales and marketing, and his success in managing large life insurance portfolios for affluent individuals and growth companies brings an unparalleled advantage to his presentations. As a speaker, author, and educator, Barry is a recognized expert in applying prudent investor principles to life insurance product selection and portfolio management. He has addressed the world's most prestigious corporations and industry groups. He has been published and featured in the industry's most read magazines, and he has been cited in legal and accounting books and journals. And now, here's Randy Zipse and Barry Flagg.
Hello, Barry. Welcome to the podcast. It's great to have you on. Thank you for spending some time with us.
Good to be back, Randy.
Hey, today we're going to talk about life insurance as an asset. Specifically, we're going to talk about how producers and advisors can better talk to their clients about the prudent selection and the proper management of life insurance. You like to talk about life insurance operating systems. Can you tell our listeners a little bit about what you mean by that?
Yeah, I recently wrote about it in my monthly column for Investment News. If anybody is interested in seeing that, you can follow me on Twitter or LinkedIn or email me. The whole operating system concept came out of conversations that I was having with producers or producer groups or insurance marketing organizations about their experience in the trust-owned life insurance business, and as it related to the experience that I've had and that Veralytic subscribers have had. They were asking, how are you getting so much better results than we're getting out of a trust-owned life insurance new business initiative, if you will? And I analogized it to different operating systems and started thinking about it that, Apple has its own operating system. I carry an iPhone around. I work on a Microsoft Surface. So I use an Apple operating system and I use a Microsoft Surface operating system for different things. And, if you try to run a Apple program on Microsoft Surface, nothing good happens. It's not to say that Apple's better than Microsoft or the other way around. It's just that they're different. And I analogize that to the operating system for the life insurance fiduciary, the trustee, or those serving the trustee, versus the operating system of the life insurance industry. And this is not to slay any sacred cows, but they're just different. The operating system for the trust-owned life insurance business, which I call the Prudent Investor Operating System, it's written down in the Prudent Investor Act. The Prudent Investor Act is the result of some 200 years of case law and regulation and experience that doesn't guarantee the client gets what they expect, but it just improves the prospects of the client getting what they expect if you do these things that are part of the operating system. And the life insurance operating system, it occurred to me, using another analogy, was built more like the automobile industry operating system, where, in the 1980s, automobile manufacturers were building high miles per gallon, high MPG cars, fuel-efficient cars, because gas prices were going through the roof. And when gas prices came down, they wanted to build SUVs and trucks. And, you build these things and you want to sell them, and there's nothing wrong with that. And that's kind of the way I've seen the life insurance industry, where in the 1980s when interest rates were high, they built universal life products that looked good. The illustration looked good in periods of high interest rates, but then interest rates came down and the products didn't look so good, so they built a new product, variable life, that looked good during the period of high stock market performance. And then the stock market dot-com boom turned into the dot-bomb crash, and variable sales fell off, so they designed a new product, and so on and so forth. And it just that operating system, the life insurance industry operating system, works fine for those who are in the life insurance sales business, but it does not meet the needs of fiduciaries. And so that's where this whole operating system concept came from.
And my experience, if you will, of the standard operating procedure that I've seen around in the life insurance business for 20-plus years, 25, I guess closer than anything nowadays, it's kind of been you sell a life insurance policy, then it sits in a drawer until somebody dies or another agent comes around and takes a look at it. Historically, after the purchase of the life policy, the fiduciary, the trustee, never really ever looked at the life insurance contracts. Annual gifts were made to the trust, the crummy notices were sent to the beneficiaries, premiums were paid, and like I said, the death benefit was received when the insured dies. But now that model really doesn't fit in the regulatory and the legal environment that we're in. Can you talk a little bit about that?
Yeah, I think the reasons for that are perfectly reasonable, perfectly understandable. In the 1970s, the principal permanent insurance product was whole life. Dividends were always greater than they were projected to that point. So if you bought a whole life policy and you stuck it in the drawer and you look at it for 20 years, when you pulled it out of the drawer, you were generally pleasantly surprised. But with the advent of universal life and variable universal life and guaranteed universal life and indexed universal life, they're much more market-based, and markets change, interest rates change, stock markets change, and these products are increasingly based on the performance of stock markets. In addition to which, with the kind of the deregulation of the life insurance industry in the 70s and 80s, the insurers were granted more leeway in pricing products, and the difference between good pricing and bad pricing became much greater than it was back in the day of rate books, when the pricing of one whole life policy and another whole life policy just weren't all that different. So the reasons for the inclination to buy a policy and stick it in a drawer and don't look at it again until somebody passes is very understandable given that background. But given the changes, the fiduciaries now have an asset where it requires ongoing monitoring. Not just because the asset itself, the life insurance policy itself, requires ongoing monitoring, because their operating system requires that they perform ongoing monitoring. And in the investment business, what trustees do is they have an investment trust, and the trustee of the investment trust, or the trustee of the trust that holds principal investments, the trustee performs the administrative and fiduciary duties, but then they hire or delegate to an investment advisor to review trust assets, look at the expenses in the assets, look at the performance of the assets, and make trade or exchange recommendations to the trust committee. In life insurance trusts, until just recently, the trustee of the life insurance trust was performing the fiduciary and administrative duties, but didn't have anybody, after the point of sale, didn't have anybody to turn to for advice as to, okay, what am I actually being charged inside this asset? What am I actually getting in performance, irrespective of whatever it may have said on the illustration? What am I actually getting in performance? And am I adequately funded? And is this the right asset to continue to hold? That is, I think, in the early stages of changing right now.
Nowadays, and it really isn't new either. I guess I should take that back. I was going to say now, trust-owned life insurance is governed by the same fiduciary rules as other trust assets, but that's not new. Although, despite the fact that that's not new, it sure seems to me that a lot of fiduciaries, including corporate ones, but especially individuals who serve as trustees of family trust, they don't seem to understand that life insurance is governed by the same rules as other trust assets. Can you tell our listeners a little bit about the Uniform Prudent Investor Act, or UPIA, and how it applies to life insurance, both purchases and the management of existing policies?
Sure. I think you're actually right on both counts. It's not new, but it's new. The Uniform Prudent Investor Act was first adopted by the first big states in 1994, and yet it's still not fully adopted broadly, to your point, to this day. But that's not terribly different from the experience that I saw, that I had a kind of a front row seat to as a pension investment advisory analyst during the days of ERISA. When ERISA was enacted in 1974, and I'm working in a financial planning firm as an analyst for pension and profit sharing plan assets in the mid-1980s, 10 years later, and the plan sponsors had not yet fully adopted or fully integrated the duties required by ERISA even 10 years later. So I know we're further than 10 years out from 1994. UPIA is a state-by-state thing. There is some differences, so it's natural for the adoption to be slower, but it's coming. And again, it goes back to the Uniform Prudent Investor Act as of 1994 in those states that adopted it in 1994, and then other states as we went along. It requires trustees to do certain things. And if they do those things, then beneficiaries don't really have, I mean, anybody can sue anybody for anything, but they don't have a cause of action. And in this day and age, they're certainly not the low-hanging fruit as others have been in some of the cases that I think we're going to talk about. So if you do those things, it doesn't guarantee results, but it just improves the probability of results. And again, the output from the life insurance industry operating system just doesn't cover those things. And so that's what I think needs to be done different. And new and different because, again, it's old in that it was adopted in 1994, but it's new in that trustees are, I think, just now getting more of their arms around those duties.
Yeah, and I think, as I said, one of the things that I think fiduciaries sometimes forget about is it just doesn't apply to the act of buying the life insurance contract. Certainly you have to have a process for that, but it also involves looking at the enforced contract and that sort of thing. But we can talk about that a little bit later. And maybe a good place to jump into the Uniform Prudent Investor Act a little bit more is the Cochran case. That's the one case that a lot of attorneys are familiar with and fiduciaries probably best know. Can you tell us a little bit about that case and what it has told us about the management of life insurance?
Yeah. They say bad facts make for bad law and good facts make for good law. I wrote a 2-part piece for Steve Lineberg's estate planning newsletter, and I think Steve captioned it with, must read for life insurance fiduciaries. I don't know if he was referring to my writing or the fact that it was just a must read case, but I think it is a very, very, very instructive case for the difference between the life insurance industry operating system that governed a lot of what happened in the Cochran case versus the prudent investor industry operating system, which the trustee was required to do but didn't, and it gave rise to some problems. So in the 1980s, Mr. Cochran purchased, I think it was $4+ million of universal life policies. We held on to that for some number of years. In the 1990s, his broker presented him with an option that he could increase his death benefit from $4 million to $8 million with, quote, no additional cost, unquote. And from a fiduciary's perspective, that's actually a misrepresentation, an incorrect statement. It was not no additional cost. It was a proposal or a hypothetical illustration that showed no additional premium based on some earnings assumptions. The $8 million variable policy was allocated to all stocks, and about half of it was allocated to small cap and emerging markets. So clearly an aggressive, from a fiduciary's perspective, from a prudent investor perspective, that's an aggressive asset allocation, and yet there was no documentation for the change from a product, an asset, a trust asset that was required by regulation to invest predominantly, as a practical matter, in high-grade bonds and government-backed mortgages. So the first asset was conservative in nature at one end of the risk profile, and the other, the variable policy, was allocated at the very aggressive or other end of the risk profile. And that was one of the first differences in the life insurance industry operating system versus the prudent investor industry operating system. Some years later, that was in the 90s. So as we approached the 2000s, the dot-com boom, after we got through 2000, turned into the dot-bomb bust, and Mr. Cochran's cash values went down by, I think it was $37,000, which was, I believe, about a 7% loss in cash values. Now, 7% loss in cash values is totally within the range of returns that you would expect from an aggressive asset allocation. In fact, in that period of time, a 7% loss was pretty darn good for what happened in the marketplace and for an aggressive asset allocation. The broker, nonetheless, came back to the client, again, kind of coming at his job from the life insurance industry operating system perspective, and said, I ran another illustration, and clearly we're not going to get these rates of returns that we once were because we are now losing money. And so he compared the illustrations of a variable policy at a low rate of return, very low rate of return, like 4%, to a GUL policy. And the variable policy was going to lapse at about life expectancy, age 80-ish. But the guaranteed policy for a lower face amount would last forever. And so they did another exchange. They did an exchange in the 90s from UL to variable. Then they did another exchange from variable to guaranteed in the 2000s. Death benefits going from $4 million up to $8 million and then down to about $2 million, a little over $2 million. As Murphy of Murphy's Law would have it, Mr. Cochran passed 6 months later, and the beneficiaries were wondering why they were only getting $2 million instead of $8 million and sued. And one reason why I think this is instructive is not only because of the clear differences between the life insurance industry operating system versus the prudent investor industry operating system, it also showed that if you follow a process, which the trustee was able to demonstrate, they had a process. The court said it wasn't perfect, but they had a process that touched on most, not all, but most of the required duties. And the court said that you don't have to be right in your decisions. They also said that maintaining the variable policy, maybe allocating the cash values differently, could have been equally prudent as the exchange, but the exchange was also prudent in what they documented and what they did. They relied on third-party information. The information from a third party with no economic stake in the outcome was a key basis of decision for the court. And so the court said, you had a process, you followed it, you relied on information from a third-party entity with no economic stake in the transaction. They actually found for the trustee, they found for the defendant, even though the beneficiary received $6 million less. So I think it's just a very instructive case for both the differences between the operating systems and the fact that if you have a process and you perform the duties and you're using independent verification, that is what the trustees need.
I mean, that's what I've taken from that case over the years is that they had a process, they followed that process, and most importantly, it involved the use of outside third-party information.
Yeah.
To me, that's what I've taken away from that case. I certainly don't know this at your level, but to me, that's what I've learned from that case. The other case that I guess people look at from time to time and talk about in this issue is what's known as the Goldman Sachs case. Can you talk a little bit about that case and what that may have added to what we learned in the Cochran case?
Now, this one is not quite as clean. The plaintiff here is a convicted felon. The convicted felon was convicted because he believed that he was convicted in part because his investment advisor kind of turned him in. So there's a grudge here. But that doesn't mean that the case is not instructive from a legal perspective. So in this case, his original financial advisor, sold him, I think it was $95 million worth of life insurance, single pay, variable life, ran illustrations at various rates of return, including zero, talked about it, and they placed the policy. 10 years later, the client fires that financial advisor, hires another financial advisor who ran a bunch more illustrations. And the second financial advisor came to the conclusion that you could have had the same $95 million, but you could have had it for $14.2 million less. So the client sued a subsidiary of Goldman Sachs, ACO, sued them for the $14.2 million difference. To me, the advisor would have been much better served. Another example of the difference between the life insurance industry operating system versus the prudent investor industry operating system. The financial advisor was seen as an advisor, not as a salesperson. They were seen as an advisor. So they had certain duties, fiduciary-like duties to the client because they were advising the client. They did a lot of advice. They ran a lot of illustrations. From a life insurance industry operating system perspective, they really did a big job, a good job. But because the first financial advisor could not describe to the court what he had done in prudent investor operating system terms, because he either couldn't or didn't say, okay, here are the duties that as an advisor we're required to do. We're required to examine expenses, check that box. We're required to set reasonable expectations as to the rate of return, check that box. So if they had gone down the legal duties that they could have pointed to in the law, then I think they would have been far better off. Instead, you had two attorneys arguing that this illustration was better than this illustration, or that illustration was better than this illustration, and it turned into something of a crapshoot, if you will. It's being litigated. It wouldn't surprise me if it gets overturned, again, because there was a lack of connection with the law, and it was more, well, what do we think about this illustration or that illustration? And you know that illustrations are useful for a lot of things, but not terribly useful for determining which product is better.
I guess the one thing about illustration is it's a pretty good certainty that that's the one thing that won't happen. But
right.
But again, you have to have a process, and comparing as part of that process, not being the only process, I think is one of the things that people need to understand. There's nothing wrong looking at illustrations and comparing them, but that can't be the extent of the analysis. Correct.
If that's your sole instrument of due diligence, then you're going to have a harder time doing business in the fiduciary space. And arguably, you're putting a life insurance trustee in harm's way. Part of the prudent investor operating system is trustees have a duty to exercise reasonable care, skill, and caution. So the chief regulatory body of the financial services industry now has a rule that says comparing illustrations is misleading. The Society of Actuaries, actually quite some time ago, published a study concluding that comparing illustrations to determine which product is better is not just inappropriate, but fundamentally inappropriate. And most recently, the OCC updated their handbook for unique and hard to value assets, which now includes a chapter for life insurance. And in that chapter, they talk about how these illustrations are subject to a high degree of fluctuation and therefore not a very reliable measure of which product is better in any given particular case. So if the sole work product or dominant work product for due diligence that you give to a trustee are comparisons of hypothetical illustrations, you're exposing the trustee to breach of their duty to exercise reasonable care, skill, and caution for relying on something that is considered misleading, fundamentally inappropriate, and unreliable by financial, insurance, and banking industry authorities. That's just not the way to get into the fiduciary marketplace.
Gary, if illustrations are insufficient as a way to make a determination on the acquisition, we're still at the acquiring stage yet. So can you kind of summarize what a fiduciary should be doing when they're acquiring that asset?
Yeah, the big three things, the things that get you out of harm's way, that prevent you from being low-hanging fruit, is you got to look at the costs inside the policy. One, Section 7 of the Prudent Investor Act, and this is in no particular order, or maybe it's in my favorite order because of the business I've founded. But Section 7 of the Prudent Investor Act says that trustees have to incur only those costs that are reasonable and appropriate. So you got to examine costs, and you got to determine whether they're reasonable and appropriate. Separate from, because there's a separate section of the Prudent Investor Act, Section 2, that says, among other things, fiduciaries have a duty to set reasonable performance expectations. For instance, in the Cochran case involved a universal life illustration at interest rates that proved to be unreasonable at the end of the day, and then they exchanged to a variable life policy with assumed earnings rates that proved to be unreasonable at the end of the day. And then they exchanged to a guaranteed policy that was clearly inconsistent with the rate of return that would be reasonable to expect from an aggressive asset allocation. So examining costs, setting performance expectations, reasonable performance expectations, and examining what's actually going on in the illustration. I was looking at a case this morning. The illustration said the rate of return was 5%, but there was 150 basis points of bonus interest credits. So the interest rate was actually 6.5%, even though the illustration showed 5%. So you got to get beneath the illustration, look at the cost, look at the performance assumptions, And by all means, don't compare one illustration to another if for no other reason it just puts the trustee in more harm's way, like we talked about a minute ago.
One of the things that you didn't mention, at least I think need to be part of the analysis as well, is the ratings of the carriers that are issuing the contracts. I mean, I would assume that's a relatively important consideration as well.
Totally. And I guess that is largely being done by most every life insurance trustee. There are a handful, call it 3, trust-owned life insurance third-party administrators, or TOLI TPAs, and that is a routine service that they provide. So you are correct. That is absolutely important, in the same way that if this was an investment trust, the trustee would have a duty to examine the rating on the bond, the cost of execution of acquiring or trading a bond, and the yield relative to that rating on the bond. So absolutely positively important. I guess I glossed over it because most of them are already doing it.
In addition to the standards for acquiring life insurance, which we've talked about pretty extensively here, and we've touched on in the Cochran case and the Goldman Sachs a little bit, but there are standards for monitoring existing life insurance. And to me, this is where fiduciaries fail even more so than in the acquiring phase, at least in my mind. Can you talk a little bit about the standards for reviewing, monitoring existing in-force insurance?
Yeah, I mean, it's not unlike what we already talked about. And in fact, I would encourage listeners to Google the West Point draft of best practice standards for life insurance stewardship. When you download that, it's a 6-step process with 17 total sub-steps, or a 6-point checklist with 17 sub-points. And there's a graphic in there that shows that if you do the first 5, and the first 5 include the things that we've talked about among some other things, but step 6 is to go back to step 1 and do it all over again. That's the monitoring is really looking at the things that are important and prudent to look at when you acquire it, but doing that periodically. And periodically could be every year, periodically may not be every year, depending upon the circumstances, the type of policy. The overall principle is, or the guiding principle is, what is prudent? You know, if it's a $10,000 policy that's guaranteed paid up, you probably don't need to review that one every year, maybe only once, maybe. If it's a $10 million variable policy with a carrier who recently announced cost increases and who's allocated to aggressive asset classes, then that one probably needs to be looked at every single year. It's what's prudent to do in the selection is also needs to be periodically done to be prudent in the ongoing management of the asset.
And Barry, we've talked about your Veralytic business, your service, but the other thing that you do in your business is you regularly work with banks and trust companies to review trust portfolios. You know, we spoke the other day a little bit about a recent experience that you had there. You completed a block of about 1,000 contracts, I think is what you had said at that time. Can you let our listeners know a little bit about kind of what you found when you went through a block of 1,000 life insurance contracts? Were they performing well? Were they appropriate investments? You know, what did that 1,000 block kind of look like from your view?
This is actually something that I didn't expect. I was actually trying to sell the bank on a Veralytic subscription. I wanted them to buy access to Veralytic reports for their 1,000 ILETs. And their last objection went something like this: Barry, we totally agree that we got to do this. We understand Section 7 of the Prudent Investor Act says that we need to examine costs. We know of no more cost-effective way of doing it. We've looked. Problem is that once we get one of your Veralytic reports and it says that we're being overcharged, we don't know what to do about that. So it dawned on us that we serve as trustee on investment trusts, and we have a trustee who performs administrative and fiduciary duties. But then we have an investment advisor that examines the costs inside the asset, inside the mutual fund, for instance, that looks at the performance of the mutual fund relative to peer group, and that makes trade or exchange recommendations to the trust committee. And so since we do that on investment trust, it seemed like a blinding flash of the obvious to do that on insurance trust, where we have even less expertise. And we'd like to ask you if you'd be willing to do that, where instead of us running the Veralytic reports and deciding what to do, you run all the Veralytic reports and then make recommendations to our trust committee, and we'll have our third-party administrator review it and approve it. And would you be interested in that? And It has turned out to be much better for my business. It has turned out to be much better for the trustee. It's turned out to be much better for the grantor. And it's something that I didn't actually even expect. But, I mean, it's something that anybody who wants to be in the fiduciary space, these banks absolutely positively need sub-advisor services for help in actually managing these assets. But the key is you can't use the life insurance industry operating system to manage assets. You've got to follow a prudent investor industry operating system or follow the West Point draft of best practice standards as your operating system. And I think there's really good business in it. This 1,000 ILETs is the first tranche of more that are coming. In this 1,000 ILETs, we found that 400 of the trusts were being overcharged. And part of our engagement with the trust company is to reach out to the grantors and to solicit their cooperation in reducing costs. If this was an investment trust, the trustee would simply make the trade or exchange, but they can't do that without the cooperation of the grantor. So part of our responsibility is to reach out to the grantor, solicit their cooperation, take them through underwriting, get them approved, and if they get approved, then we show the trustee, here's what you were being charged, here's what the grantor is qualified for, here are the cost savings, and here's the grantor's intent for those cost savings, all documented for the trustee's file. Trustees happy, grantors happy, beneficiaries are happy, and it's turned out to be good business for us.
And Barry, we've talked about Veralytic off and on throughout this interview in the last half hour, 40 minutes, but why don't you take a minute here and kind of tie that up a little bit, just so our listeners are sure about what Veralytic is and how it can be of use to, both agents and fiduciaries, how it's used.
It's always difficult to answer that question because it has different utility in different cases. One of the early complaints or objections that I got to it is it's too complicated, it's too much information, it violates the KISS sales principle, and so it does different things in different situations, which means it's got a lot of utility, but it's hard to describe what it does. But in short, in the 30-second elevator speech, it measures costs. It also considers ratings, but as I said, most trustees are already getting that. It considers ratings, measures internal costs relative to the universe of peer group alternatives, measures the stability of those pricing representations, measures the accessibility to cash values. If all other things are equal, a policy that has cash value is better than one that doesn't. And it measures the actual historical performance of invested assets underlying cash values, which is really important in documenting the performance of Section 2 of the Prudent Investor Act. Earlier when I said measures costs, that's important for documenting the performance of Section 7 of the Prudent Investor Act. In a nutshell, that's what it does. I'm happy to provide a complimentary report to anybody who's listening for whatever life insurance matter they may have on their desk right now, and talk through in their situation what it would actually mean to them in more specific terms and help them understand the utility of it in their situation.
I guess, Barry, when I look at Veralytic and I look at the reports and I look at what it is and what it does, to me the easiest way to understand it is, if I'm explaining it to a fiduciary, is it's very similar to some tools that the fiduciary already uses when looking at securities.
Yeah.
Or mutual funds. It's very similar, right?
Yeah. So ERISA requires the performance of certain things. So then vendors, research publishers, software providers built businesses around helping fiduciaries perform those duties. Veralytic is no different than that. There are required duties that trustees have to do. They're not all doing it right now, but they have to do them. And Veralytic is simply a tool that is the fastest, easiest, most cost-effective way of giving the fiduciary the documentation they need to perform their duties.
Is there any other advice or information that you would like to share with our listeners?
I'll tell you, I came into the financial services business some 35 years ago in the mid-'80s when ERISA was just taking hold, when former stockbrokers turned investment advisors and built themselves terrific businesses by guiding clients through a proven decision-making process to solutions that were in their best interest. And I just think with insurance companies increasing costs and performance that has consistently disappointed client expectations over the past 3 decades or 4 decades, Clients are in desperate need of help with this last, largest, most neglected asset on their balance sheets, and fiduciaries need just as much help or more. I just think there is a terrific and virtuous business that some people are going to build on offering life insurance advice and managing life insurance either as a advisor or a sub-advisor to a fiduciary, and grow their businesses in the same way the stockbrokers did in the mid-1980s and built giant RIAs. I just think that's what's coming, and be happy to talk to any of your listeners about it.
Thank you, Barry. I appreciate you taking some time with us to talk about that. We've had this conversation a few times in the past, Barry, on past podcasts and at conferences. And, I'm a little bit surprised, I guess, by how slowly it seems that this world has evolved. We've got the Cochran case. We got the Goldman Sachs case. I'm surprised that there isn't a lot more out there. Can you just... I think we're getting real close to where we're going to see these sorts of issues explode, but I guess that's just me.
Yeah, I would have thought it would have happened before now, but I do think more is happening. I do think there's going to be that catalytic event, just like there was in the mid-1980s, where the growth of mutual funds and the growth of investment advisors just skyrocketed. I think there's going to be a catalytic event or a number of catalytic ingredients. I don't know what those are yet, but I think they're coming. And in the meantime, I'm writing about it in my monthly column. I had mentioned that anybody who is interested in getting the monthly column, follow me on LinkedIn. Just search for Barry Flagg, or on Twitter at Barry D. Flagg, or email at bflagg@Veralytic. I think it's going to be a big business. I just don't exactly know when the hockey stick growth is going to happen.
Well, thanks, Barry. I know our listeners will benefit from that, both the producers, who, frankly, a lot of times the fiduciaries are relying on,
Yep.
and for those lawyers and trust officers that are on this call as well. So, again, thank you for letting us hear your experiences, and I look forward to talking to you again real soon.
You're welcome. Always good to be with you, my friend.
I want to remind you to subscribe to our iTunes channel. Just search the iTunes store for AXA. This is the best way to ensure you never miss a podcast, and there is no charge from iTunes for the podcast or subscribing. Or listen to it online at www.axa.us.com. For additional information, contact your AXA representative or the advanced sales team. The opinions represented here are those of the speaker and are not necessarily those of AXA Equitable Life Insurance Company or any of its affiliates. Please be advised that this podcast is not intended as legal or tax advice. Accordingly, any tax information provided is not intended to be used and cannot be used by any taxpayer for the purpose of avoiding penalties that may be imposed on the taxpayer. The tax information was provided to support the promotion or marketing of the transactions and matters addressed. The client should seek advice based on their particular circumstances from an independent tax advisor. Neither AXA Equitable, AXA Network, or Money Life Insurance Company of America, nor AXA distributors provide legal or tax advice. Life products are issued by AXA Equitable Life Insurance Company, New York, New York, or Money Life Insurance Company of America, an Arizona stock corporation with its main administration office in Jersey City, New Jersey, and are co-distributor by affiliates AXA Networks, LLC, and its subsidiaries, and AXA Distributors, LLC, New York, New York, 10104.